The broadcast is now starting. All attendees are in listen-only mode.
Good morning to those of you here in the US, and good afternoon to those of you in Europe and other countries. We welcome you to the Investor Responsibility Research Center Institute's webinar today on the effects of short-term incentives. Our agenda today is logistics and introductions, an in-depth review of the research, and then we'll take your questions. In terms of logistics for today's webinar, all attendees are in listen-only mode, but we do welcome your questions. You'll notice on your control panel there's a question function. Throughout the presentation, if you have questions, just type it into that question box. Following the presentation, we'll read those questions aloud and respond to them. This session is recording. A replay will be posted at www.irrcinstitute.org by tomorrow. We welcome you to share information about this webinar and the research on social media. You can find us on Twitter at IRRC Research and @LBS. If you should have any technical issues or audio issues during the webinar, feel free to contact GoToWebinar at 1-800-263-6317. Our speaker today is Alex Edmonds, Professor of Finance at the London Business School. Alex's research interests are in corporate finance, behavioral finance, corporate social responsibility, and practical investment strategies. His work is widely published in the American Economic Review and the Journal of Finance, for example, and his research has been covered by publications including the Wall Street Journal, the Financial Times, the New York Times, the Economist, BBC, CNBC, CNN, among many other outlets. After graduating from Oxford University, he worked at Morgan Stanley, both in New York and London. And after earning a PhD from MIT Sloan as a Fulbright Scholar, he joined Wharton in 2007, and then he moved to the London Business School in 2013. This year, Alex and a team of researchers were the recipients of the IRRC Institute's 2000 Investor Research Award. These winning research papers are the topic of today's webinar. For those of you who aren't familiar with the IRRC webinar, it's an annual research award recognizing top research that examines the interaction between the real economy and investment theory. The award is available to both academics and to practitioners, and each year 2 award teams are given a $10,000 prize. And just a couple words about the IRRC Institute if you're new to the organization. We are a nonprofit that was established in 2005, and essentially what the organization does is it funds and disseminates objective, unbiased research on a range of issues at the intersection of corporate responsibility and investors' informational needs. We have more than 65 research reports available at no charge at www.irrc Institute, and of course we welcome you to the website to take a look at all of those research papers, and you can also download both research papers that Alex will be referring to today. So with that, I am going to attempt to give Alex control of the slides so that he can move the slides for you. And Alex,
yeah, I see.
You should have control of the slides now.
I did, but the screen has just completely disappeared. I had them, but then something happened.
Okay, well, you know what? Let's go back to me controlling the slides. And if you can just bear with us for 1 second. Okay. Can you see the slides now, Alex?
No, I could see them until you said, I'm going to give you control of the slides, and then they disappeared, so I couldn't do anything.
Okay. So let me see if I can get this working for us. Okay. Can you see the slides now, Alex? It looks like I'm going to have to keep control of them, so sorry about that. So just prompt me to move them to the next slide, and I'll keep up with you, okay?
Sure.
Okay, there we go.
Okay. Well, welcome everyone to the call. It's really good to have so many people interested in research. When you spend so many years working on a paper, you hope that it's not just read by other academics, but it affects the way that people think and act about corporate governance. And it's great to have this award from the IRC, which is playing a leading role in disseminating the findings of rigorous research to a practitioner audience. So I'm going to present the paper for about half an hour or so, and I look forward to your questions and challenges at the end. But before I get started, let me just start with the general context. So what did we want to explore in this paper? We wanted to explore executive compensation, but a rather different dimension to what we typically see in practice. So CEO pay has captured almost everybody's attention. So if people were to cite one statistic as to why is business out of touch with society, they're probably going to focus on how much CEOs are paid, in particular how much they're paid relative to the ordinary man or woman on the street. For example, in the US, in Fortune 500 companies, CEOs are paid $10 million. That is over 300 times the pay of an average person, which just seems outrageous. Yes, we understand that CEOs may be in short supply, but should they earn in a day what a person earns in a year? Many people find that hard to believe. However, what we argue in this paper is that the level of pay may not be the most important dimension that responsible investors such as yourselves should necessarily look at. So it's true that $10 million is a lot compared to the average worker, but when you compare it to overall firm value, it's actually pretty small. So 10 million of pay compared to the average firm size of 20 billion is just 0.05% of firm size. So that's not to say that we can just be blasé about the level of pay and ignore it, because anything is small when you compare it to the size of the overall firm. But it's to say that other dimensions of pay might be more important, because indeed what matters is not the level of pay, it might be the structure of pay, and in particular the horizon of pay, whether pay is short-term or long-term. Because if we get the horizon wrong, if pay is too short-termist, then CEOs take too short-term actions, and that can have decisions which have percentage point rather than basis point effects on firm value. So what we want to do in this paper is change the conversation from being the level of pay to the horizon of pay, whether it's short-term or long-term. So we want to move from quantum to pay design. Now, there's a lot of belief among practitioners and academics that short-term incentives are a bad thing. So many of you will know Bev Sugar-Fried's influential book, Pay Without Performance, where one of the things that they're saying is, well, actually, the horizon of performance is problematic. And in the follow-up they had, one of the big solutions they're proposing is pay for long-term performance. So rather than giving CEOs equity, which may have a 1-year lockup period, give them CEOs with a 5-year lockup period. And indeed, in the UK government's green paper on corporate governance reform has recommended increasing the vesting period of equity from 3 years to 5 years. So we have that belief among practitioners and academics, but actually there's very little evidence that short-termism is a problem in reality. So what is the common evidence that people cite when they're arguing that CEOs are taking too short-term actions? Well, the most prominent academic paper was a very influential survey written in 2006, where 78% of executives said that they would cut investment to meet quarterly earnings targets. But that's what CEOs or CFOs say they will do. That's not evidence of what they will actually do. Now, over the past year, a study by McKinsey and Focusing Capital on the Long Term has captured the attention of many people with an article in Harvard Business Review saying, finally, evidence that managing for the long term pays off. And their main evidence was they had a measure of a company's long-termism, which included things such as how much they invested. And they found that companies that invested more today had higher returns in the future, higher stock returns. And so their interpretation is that taking a long-term approach, investing more, causes higher long-term returns in the future. But this is only correlation, it's not a causation. In fact, it's equally plausible that the results from the opposite direction. When you expect your stock returns to be high in the future, i.e. when the economic outlook is good, you are more likely to invest today. Indeed, that's presumably what McKinsey tells its clients. That's Finance 101. You invest when times are good. So the expectation of future good prospects causes you to invest today, rather than investing today causing future growth prospects. And so this is very important, because many people, myself included, we like to believe that long-termism is good and that short-termism backfires. And so we're very willing to believe studies that show this, but some of the evidence that we've seen out there is actually pretty weak. Indeed, the title of their first article was not finally evidence that managing for the long term pays off. It was finally proof that managing for the long term pays off, until Harvard Business Review got so many complaints that they were overselling it that they changed things. So let's go back to CEO pay. So if you like to show that CEOs take short-termist actions because their pay is tied to the short term, what might you like to do? Now, one thing you could do is look at when the CEO sells her shares and see whether the CEO cuts investment at the same time that she sells her shares. In that case, you could say, well, because the CEO knew that she was going to sell her shares, she cut investment in order to pump up the stock price. But again, there's a problem here with correlation versus causation. Maybe there's a common factor that drives both. Maybe the CEO knows that future prospects are poor. If you know that future prospects are poor, you should cut investment, as I've explained. And also a CEO would choose to sell stock. So there's a correlation between the two, but one is not causing the other, so you need to be very careful. So that's where our paper comes in. So what we aim to do is to be the first paper to show a causal effect of short-term CEO incentives. And so how do we get this causal effect? So what we want to do is we want to look at something that causes the CEO to sell equity now, but is a random event. It's not something which is the CEO's discretionary decision. And so what we're looking at is the scheduled vesting of equity. So here's the idea. Let's say 5 years ago, in February 2013, the board decided to give the CEO a chunk of shares with a 5-year lockup period. So that 5-year lockup period expires now in February 2018. And what we can show in the data is that when the lockup period expires, the CEO chooses to sell her equity. That makes a lot of sense. She wants to diversify. Okay, so when the lockup period expires, the CEO will care about the stock price. So this is known as relevance in the terminology in the first bullet point. But also, what is causing the CEO to sell her shares now in 2018? That was a decision made 5 years ago in 2013. So that's unlikely to be driven by the current prospects of the firm, which are things which would also drive investment. So just to repeat this, what we want to look at is something that causes the CEO to care about the stock price now, but is unrelated to the current incentives to invest. And that thing which causes the CEO to care about the stock price now is the fact that 5 years ago, she was given equity which had a 5-year lockup period. Okay? So I wrote on my blog, so my blog generally tries to explain sort of complex academic concepts to a practitioner audience. I wrote something, just going back to the last slide, it was called A Layman's Guide to Separating Causation from Correlation, which just goes through some of those strategies in how to separate the two out, and also how as practitioners we should be skeptical about potential studies like the McKinsey one, which claim to be causal when they only find a correlation. Okay, so that's our strategy. So what I did in one of the papers that won the award was to look at what happens to investment. When the CEO has a lot of equity vesting, does she indeed cut investment? Now notice there's many other things which might cause her to cut investment, not just whether she's selling equity, So we control for the other parts of her compensation, how much salary, bonus, unvested stock she has. We also get control for the CEO's age and tenure, because younger CEOs might have longer time periods. We control for investment opportunities, and we control also for how much financing the CEO has, so how much cash the firm has to finance for investment. And after controlling for all of that, what do we find? Well, this is on the next slide here. What we find is that when the CEO has more equity vesting, she significantly cuts investment, and that is true for all 5 measures of investment. So we look at R&D, column 1, capital expenditure, column 2, another form of capital expenditure, column 3, but estimated using the cash flow statement using the balance sheet rather than the cash flow statement. And also in columns 4 and 5, the aggregate of R&D and CapEx together. For all of these, we find that the more equity the CEO has vesting, the more she is cutting investment. And in terms of numbers, a 1 standard deviation increase in vesting equity causes a CEO to cut investment by about $2 million per year. So we think this is a comforting number, because that 2 million is significant. It's not small, but it's not so large to be implausible. If we came up with a number like 200 million, then on the one hand, you might say, oh, this paper finds blockbuster impressive results. But on the other hand, you might say, well, those results are implausible, because if it's 200 million, surely the board should step in and do something about it. So the fact that we find something which is not small, but also not implausible either, gives us some credence that the results are robust. Okay, so moving on to the next slide here, there's many ways of interpreting what we found. So one interpretation is the CEO is being myopic. Vesting equity, the fact that the CEO cares about the short-term stock price, causes her to cut investment, which would have otherwise been good, and therefore this is a bad thing. But notice that actually there are other interpretations which are not so negative. And again, what I want to stress is that we should always allow for alternative explanations. There's so many papers now trying to find a smoking gun, trying to argue that CEOs or investors are crooked, when actually there could be more reasonable interpretations of the same data. So rather than chasing after headlines and saying, here we found a smoking gun, instead we wanted to give due regard to other viewpoints. And one of them is the idea that the cut in investment could be efficient. So here's the idea. Maybe CEOs generally overinvest. And that's not implausible, because there's evidence showing that the larger the firm a CEO works for, the more that she's paid. Indeed, we know stories like RGR Nabisco in the 1980s, which just grew too much. And so maybe here actually short-term concerns are a good thing. Like if the CEO cares about the short-term stock price, that will cause her to actually just cut slack, just to get her act together and cut these bad investments. A bit like, say, an exam at school that causes short-term cramming by students, but that might actually be a good thing, because that causes students to study when they otherwise wouldn't. We rule out that interpretation. Well, what we're arguing is that if indeed vesting equity, a concern for the short-term stock price, causes the CEO to get her act together and cut unnecessary investment, it should also cause her to cut investment, to cut other types of unnecessary expenditure, such as operating expenses and COGS, or maybe improve things like sales growth. And we find no improvement in all of those other areas. So what we find is that they're just cutting investment, they're not making other general operational improvements, and therefore it doesn't seem to be something consistent with a general efficiency interpretation. Okay, we're going to skip 2 slides forward. There's some other hypotheses that we try to address, but I'm not mentioning this here for interest of time, but I just want to put them on the slides just to show you that there's many other hypotheses that we wanted to rule out. We didn't want to immediately jump towards a smoking gun explanation. So now looking at, well, does the CEO benefit from all of this? Because some of you might think, well, there's a little bit of a problem here in terms of the timing. So what we look at is the relationship between vesting equity in a particular quarter, how much equity is vesting, in Q1 2018. And then we look at, does the CEO cut investment in Q1 2018? But if the CEO cuts investment in Q1, that boosts earnings in Q1. But those earnings are not actually announced until Q2, because earnings are announced with a lag. So if the CEO is selling in Q1, how does she benefit? So what we actually find in the next slide is that the CEO communicates her investment cut and therefore her increase in earnings ahead of time. What we find is in the same quarter in which the CEO cuts investment, she also announces positive earnings guidance, but not negative earnings guidance, always positive earnings guidance, and also engages in other communications which cause equity analysts to upwardly revise their forecasts. And also it causes the CEO to beat the earnings target by just 1 cent or exactly meet it. And so these findings should be concerns for you all as responsible investors. What the CEO cares about in the quarter in which she sells equity is cutting investment and focusing on give positive earnings guidance and increasing analysts' expectations, so just boosting the stock price potentially at the expense of long run value. Okay, so that concludes one of the papers that we wrote, and the second paper, which we were lucky to win the award for, goes further than that. So what the first paper looks at is investment. And why we looked at investment is this is perhaps the most important everyday decision that a CEO would undertake. But we still shied away from saying that this was damaging to long-term value, because if you're cutting investment, as I mentioned earlier, you don't know whether you're cutting good investment or bad investment. You can only observe in the data the level of investment, but not whether it's good or bad. I mentioned that we did some other things to try to rule out that there were not general improvements in efficiency, but that was more an indirect test, so we didn't claim that we'd found myopia. So that's why the final version of the paper was called Equity Investing and Investment, not something like Equity Investing and Value Destruction or Myopia. So what we want to do in this follow-up paper is to try to show that there's negative consequences of the CEO's short-term actions. And to do this, we had to look at something other than investment. Why, as I mentioned earlier, with investment, you don't know whether investment is good or bad. So instead of investments, we look at two things. And those two things, just moving to the next slide, one of them is share buybacks. Now, share buybacks can actually be a good thing sometimes. They can be a good way of returning capital to shareholders, which might otherwise be wasted. Indeed, in the Harvard Business Review, I wrote an article called The Case for Stock Buybacks recently, showing that stock buybacks can indeed be good. But they could be bad. Like maybe you're buying back stock when and you're cutting investment to do so, or you're buying back stock even if the stock was overvalued. Now, the important thing here is with a repurchase, you can measure the long-term return to the repurchase. You can look at what happens to the stock price after the repurchase to see whether the repurchase was a good or bad transaction. And the second new thing that we look at in this paper is mergers and acquisitions, which also are things which can boost the short-term stock price, but also harm long-term value. And indeed, this paper by Agrawal, Jaffe, and Mandalka found that the M&A deals that the market reacted most positively to in the short term actually destroyed the most value in the long term. An example of such deals is there might be deals which increase the earnings per share in the short term. The market likes them, but actually they destroy value in the long term. Okay, and again with M&A, because we have a clear announcement date, you can look at the long-term returns to a merger. And let's give you an anecdotal example of a type of merger that we have in mind, which actually might destroy long-term value, but create a boost to the short-term stock price. And this is on the next slide, and this is the case of Bazaar Voice, which acquired Power Reviews in June 2012. That caused the stock price to soar above $20, and Bazaar Voice's officers and directors sold 90 million of stock which they couldn't have sold otherwise because before that it was locked up after the IPO. Now, the US Department of Justice shortly after commenced an antitrust lawsuit in January, causing the stock price to fall to $7. But the officers and directors were sitting pretty because they'd already cashed out at $90 million. And they sort of knew probably that this antitrust lawsuit should have been likely, because internal communication showed that the motive of the deal was the elimination of our primary competitor to leave us with literally no other competitors. But they were able to fool the market for long enough in order for the stock price to go up. And indeed, we just combed through all the analyst reports, and all of the analysts responded positively. They didn't think antitrust was likely. It was only the directors who thought this because of their internal communications. So what happened after the fact was an activist shareholder came in to launch a lawsuit to actually change things such as the compensation policy to increase the vesting horizon to 5 years, because one of the concerns which led to this problem was having too short-term incentives and cashing out. And actually, the activist shareholder wasn't someone scary like Nelson Peltz. It was me. So this was something that I worked on in terms of my own involvement in the real world. But what I wanted to look at was this something which is more than just this one anecdotal example, and that's the motivation to write the paper. Okay, so moving to the next slide, what did we actually do and what did we find? So what we find here is something pretty similar to what we showed last time for investment, is that repurchases go up when equity is vesting. But that's not that novel a finding to the last paper, because it just shows that what we found with investment, we also find with repurchases. So the main novelty of this new paper is on the following slide. What we do here is we look at the long-term and short-term returns to repurchases. I'd like you to look at column 1. What that shows is in the 2 quarters surrounding the vesting equity, you see the stock price going up compared to benchmarks, regardless if you use the market or industry or firms with similar characteristics, which are the 3 columns. But now looking at columns 2 and 3, we find significant underperformance for the next 8 quarters afterwards, showing that these repurchases actually destroy value in the long term, which is why this new paper is called The Long-Term Consequences of Short-Term Incentives. And moving to the next slide, what we find is similar results with M&A. Right, when there's more vesting equity, CEOs are more likely to undertake M&A. But moving to the next slide, that M&A creates high short-term value, again looking at column 1, but destroys long-term value. And here we're looking at negative results, not just in columns 2 and 3, but also 2, 3, 4, and 5. So the negative long-term returns persist even longer for M&A than they do for repurchases. Okay, so moving to the next slide here. What do we find? So when we combine those 2 papers, what's the punchline for you all as practitioners? Well, it's a couple of things. So number 1 is to focus not just on the level of pay, even though that may be the most emotive dimension, but the horizon of pay, because that affects the CEO's incentives, in particular the incentives to take short versus long-term decisions. In the first paper, we showed that when the CEO has short-term incentives, they cut investments, and in the second paper, we showed that they take other actions, repurchases and M&A, which have negative long-run consequences. And indeed, this is something which we think is now changing the real-world debate, is the UK's governance green paper hasn't suggested a cap on the level of pay, but also increasing vesting periods from 3 years to 5 years. And also the Norwegian Sovereign Wealth Fund, they issued a statement last February saying that they want CEOs to hold longer term equity, and many companies in the UK, Unilever, Kingfisher and RBS all implementing this. And indeed, I also have on the same blog that I mentioned earlier, an article called Simplicity, Transparency and Sustainability, a new model for CEO pay, which is talking about the reforms suggested by this paper. And more broadly, what we're trying to do is just change the conversation from pie splitting to pie enlarging. So many people here have the austerity mentality. That mentality is that the world is a fixed pie. So the only way to increase your share of the pie is to make others' shares smaller. So why did we have Brexit in the UK? Well, one of the reasons is how to improve local people's lives, make foreigners worse off, so stop immigration. And similarly, why is there such a big debate about pay in the UK and the US? We think if we're to reduce the slice taken by the CEO, reduce her pay, there's more pay to be redistributed to employees. But as I mentioned earlier, that amount that we can redistribute is 0.05%. If instead what we do is give the CEO the right incentives and cause her now to take long-term rather than short-term actions, we grow the pie and therefore everybody's slice increases. So we're changing now the conversation from pie splitting and austerity to pie enlarging and abundance. And some of you will know the book 7 Habits of Highly Effective People by Stephen Covey, perhaps my favorite business book of all time, which talks about the abundance mentality, which sort of makes a lot of sense when you read his book. Sadly, it's not present in many of the real world debates. So this is how we're trying to change the debate towards pie enlargement. The final few slides, I'd like to share some of the policy debates I've been heavily involved in over the last couple of years since moving back to the UK. Is that it's really great that we're focusing on academic research in this core, but academic research can often be abused in that one of the most sort of dangerous phrases you could ever have is research shows that. Because research can show whatever you want it to show, right? I could form any opinion. I could probably, if like, let's say I love red wine, I'm sure I could find a study showing that red wine is good for your health. And indeed, this is how the anti-vaccination movement got started, is there were some studies claiming to show that vaccination caused autism. And indeed, executive pay, because it's something that evokes such strong emotions, it's also something which potentially leads to research being misused. So in the UK House of Commons Corporate Governance Inquiry, I was testifying as a witness in this, and the witness before me referred to a study showing that the higher the ratio between CEO pay and worker pay, the worse the firm performs, arguing that this is demotivating. Now, what they did is they quoted a half-finished study, which is the quote that we see here, when actually the paper had been published a few years previously in final version, and the published version is on the next slide here, and the published version finds completely the opposite. So it finds we do not find a negative relationship, we find that firm performance increased with relative pay, perhaps suggesting when you're hiring in some good management, this is actually improving the productivity of the entire firm. So what this witness did was they handpicked an example of a paper. Even when the final version was available, you can always find a half-finished interim draft to support whatever you wanted to support. So what we want to do is go by the rigor of research, not whether it supports our viewpoint. Moving on to the next slide, we also find a case in which the FT had a study which hit national headlines, finding that UK CEOs earn too much and there's no link between pay and performance, which seems striking. But this study had two problems. Number one, the study did not even exist, right? So they based this article on just the press release on the study when the study wasn't out. So how do we know whether it's robust or not? But because this played into people's viewpoints, that's why something like the FT was able to write about it. And number two, with no disrespect to the business school that produced this study, if I was to mention the name, probably none of you would have heard of it. Which is important, because if you were to seek medical advice, you'd like to listen to maybe Harvard Medical School rather than a place that you hadn't heard of. But again, here, when opinions are so strong, we will listen to opinions that we believe rather than opinions that are from trusted sources. And that moves me to the final slide of the entire talk here, which is, I think, academic research has massive value for the real world, which is why I applaud the IRC for having this award. We often think that academic is the opposite of practitioner. So there's so many panels I speak on where I give the academic perspective and then there's practitioner people afterwards, when in fact what we do is we answer the same question but from different vantage points. The advantage of academics is we have maybe 5 years to write a paper. This paper took over 5 years to write, but to make sure it's absolutely rigorous, we were able to address the alternative explanations. But there is this caveat, there's a lot of bad academic evidence, so what we want to do is focus on the highest quality research, and one good guide is research published in the very top academic journals, rather than something that might be in draft form and from institutions that you might respect. And this is not to be elitist, but this is just to say when we're thinking about something as serious as how to reform governance, which I know you take seriously, we'd like the very best evidence to guide us. At the moment, we see something similar to an Alice in Wonderland, where at the end, the Red Queen has the sentence first and the verdict afterwards. What you've decided what you want to show, and then you find evidence to support it. Whereas what we want to do is we want to try and have an open mind and then consider the highest quality research. And my latest TEDx talk, From Post-Truth to Pro-Truth, is on this, and also with some practical tips in order to try to address this concern of confirmation bias. But the final bullet point I'll leave you with is what I try to do in my blog called Access to Finance is to translate a lot of these really good academic papers, but into a general audience, because a lot of them are very densely written. I'm trying to take the ones which are of greatest relevance to practitioners and also provide both sides of an argument. For example, despite me being a strong Remain supporter, I also did a post on the case for Brexit based on some good economic arguments. So to the extent to which there's other things on corporate governance which are interesting to you, this is a potential source. Well, thank you very much to everybody for their attention, and I look forward to hearing any questions and challenges.
Thanks so much, Alex. Now we're on to the Q&A portion of the webinar. If you have questions, as a reminder, there's a question box on your control panel. Just type your question into that question box, and I will read it aloud, excuse me, and Alex will respond. Looks like we do have a couple questions in the queue, and I'll read those to you, Alex. The first one is, well, actually the first one I can take. Will we be able to receive a copy of the slides at the end of the presentation? These slides, as well as a recording of this webinar, will be posted by tomorrow at the latest, perhaps later today, at www.irrcinstitute.org. So I'll get those up for everyone. Our second question, should directors be paid in restricted stock? Should CEOs?
Yes, absolutely. Thanks for that suggestion. And that's the main thing that comes out of the research, is that if you want to design pay, just give something very simple, which is equity with a long vesting period. So maybe equity locked up for 5 years or perhaps even 7 years. And also that's actually in a somewhat different direction to where we see many people pushing towards. So what people have tried to push towards is having performance conditions, so you need to meet particular thresholds for your equity to vest. But there's other evidence showing that that causes CEOs to take short-term actions to meet those thresholds. So instead of giving something very complex, and complexity sort of leads to the public being even more suspicious, just give straight restricted stock where you say you have to hold on to it for maybe 5 or 7 years, and that would be a much better option. And that's what I consider in the blog post called Simplicity and Transparency.
Thanks, Alex. Here's our next question. What would happen to total CEO pay if the vesting length increases? Does the CEO ask for a premium?
The answer is that the CEO might ask for a premium, because if the CEO now has to hold their shares for 5 years rather than 2 years, he or she might demand a little bit more. And if that's the case, is this a price worth paying? I argue it definitely would be. So let's say the CEO would demand, say, an extra $1 million. That's far much higher than what I'd expect would be reasonable. But that $1 million is 0.005% of firm value compared to the substantial improvement that you'd have in terms of long-term decision making. So I think of like long-term equity being a bit like a risk management system. So if a company was to implement a risk management system and have a lot of risk management officers, that probably costs several $1 million. That's an expensive thing, but it's worth it because you avoid really bad outcomes. And here, by removing the CEO's incentive to take short-term actions, I think this is potentially a price worth paying. And again, this is a downside of focusing on just the quantum of pay or the ratio of the CEO's pay to the median worker pay. Because a CEO might say, I'm quite happy taking a pay cut from 10 million to 9 million if you just shorten my vesting period from 3 years to 1 year. Doing that would improve the pay ratio and would improve the optics of pay, but in my view would make pay much worse because it's the horizon which is a much more important dimension.
Thanks, Alex. Our next question. Do you find that companies who do buybacks adjust EPS targets accordingly?
This is really interesting that you're asking this, because I'm actually conducting a study at the moment mandated by the UK government. So the UK government has launched an inquiry into whether buybacks are being used by CEOs to inflate their pay by indeed meeting EPS targets. And while we don't have, the study is still in process, so I can't give specific numbers. What I can say, I think the most I can say for now, is that some companies do and some companies don't. And we're trying to get this frequency by actually surveying the companies. So some companies are aware of this, and this is the idea that a repurchase almost mechanically increases the earnings per share, but some don't adjust for this. But again, this is one advantage of looking at long-term equity, restricted stock, as the first person asked, right? This idea of performance vesting equity, giving CEOs EPS targets, does encourage them to take short-term actions to meet the EPS targets, such as repurchases. And even if you were a savvy contract designer and said, well, we're going to adjust the EPS target for repurchases, there's many other things that you can do to meet an EPS target, such as cutting R&D. So the best solution to this is not just to adjust the EPS target for the repurchase, but to scrap EPS targets entirely and just have long-term equity. Because when you give long-term equity, the CEO has to bear the long-term consequences of her actions. And indeed, any repurchase that boosts the short-term stock price but destroys long-run value will also destroy the value of her wealth.
Our next question, Alex, is what do you think about the effect of information asymmetry on opportunistic short-term returns?
So let me just try to infer what I think the question is asking. So is this information asymmetry in terms of management having more information than investors? So this might manifest in many ways. It could well be that if management thinks that their stock is undervalued, right, they will buy back shares because they know that the valuation is higher than it should be. Sorry, the valuation is lower than what the true value is worth. Or similarly, it could be that if a manager engages in an investment, but the company doesn't know that it's invested, it thinks it's just had low earnings, that also causes the company to be undervalued. And so I agree that information asymmetry may lead to these opportunistic behaviors. So what is the solution to that? I think the solution is to modernize reporting. So at the moment, we still have this focus on quarterly earnings within the US. In the UK in 2014, they stopped the requirement for quarterly earnings, and some companies like Unilever decided to stop reporting, but actually only 9% took advantage of that flexibility. But if we now move away from a reporting focus on just quarterly earnings to more towards reporting of more holistic dimensions of a company's value, such as the corporate culture, the innovative capability, customer loyalty, brand strength, all of these intangibles, then this leads to a much better information about what a company is truly worth. And this is something that I explored in my first TEDx talk, which is called The Social Responsibility of Business. Indeed, if you look at some of the most valuable companies today, these tech firms, it's not the earnings which are driving their value. Many of them might not even have positive earnings, but it's things such as the number of subscribers and the loyalty of the customer base, how much time a customer spends on an app. And those are things that we'd like to have more reporting of in order to reduce the information asymmetry, which, as the participant correctly says, could lead to opportunism.
Our next question, could you explain again how we can enlarge the pie as opposed to splitting it?
Absolutely, yeah, this is an important point, so I'm happy to explain it again. So let me just go back to what do we mean by pie splitting? This is the idea that there's a fixed firm value, and so the only way that other stakeholders will benefit is if the CEO or shareholders are worse off. So you can get a greater slice if anybody reduces their slice. So they think, well, let's make sure CEOs are paid less by putting on pay caps, and therefore there's more to go around. But in fact, the pie, the value of the firm, is not fixed. If we encourage the CEO to engage in innovation, right, that grows the pie, that increases the value of the overall firm. And if the overall firm value increases, the whole of society increases. Now you might think, well, if the value of the firm increases, well, isn't it just shareholders who benefit? Do society benefit? Well, first, I'd say, who are shareholders? Right, they're not nameless, faceless entities. Shareholders, for many cases, are individual investors who own retail mutual funds, or it might be a pension fund which is investing for retirees. So if shareholders benefit, often shareholders are ultimately people. Number two, do employees and stakeholders benefit? They absolutely do. For example, if the company's more innovative, it's likely to create more jobs going forwards, and it's likely to stay around and not suffer collapses, as some non-innovative companies have done. And one way in which you can make sure the employees benefit even more is give broad-based employee stock plans. So give shares to not just the CEO, but also to employees, which I also write about in my blog post. Because if the firm does well, there's probably not just the CEO to thank, it's probably the employees as well have contributed. And so giving shares to all workers is a way of rewarding them and also just creating a combined, united mentality rather than a them or us mentality, which has led to the distrust in business. And finally, do customers benefit? Well, let's take the banking industry, for example. So in the banking industry, people have this conception that it's just the fat cat top bankers who get wealthy. Nobody benefits from technology and innovation. I beg to differ. Right now, what can we do? We can deposit checks using an app on our phone. Go back to the days where if you got a check, you had to physically go to the bank, and that was just time consuming. And now you can just transfer money easily online between different bank accounts. Now you've got chip and pin in the US, which is a more secure way of paying with your card. In the UK, we now have contactless payments. So all of these things do make people's lives easier. I know that people often will quote the fact that, well, the CEO's salaries have gone up faster than the median worker salaries. And again, that's not something we can be blasé about, and that's why I suggest things such as broad-based employee plans. But if we're just looking at the median worker salary and say, well, because the median worker hasn't benefited in terms of salary, he hasn't benefited, I think that is too narrow and too reductive, because there's ways in which you can benefit other than through salary. For example, I think our lives are much easier that we can bank online, or that we have Google search or Google Maps. Those are things which benefit the ordinary man or woman on the street, which are not captured by salary figures.
And it looks like we have one more question in the queue, Alex. Have
Sure.
you had any reaction to your work from practitioners and compensation committees?
Yes, I have, and this is what's really exciting about the research, and I love the engagement with practitioners. Is that I was I've talked to, I can't mention particular investors' names, but many investors I talk to about how to reform pay on this dimension. A lot of the work I've done in the UK has been with Tom Gosling, who is the head of PwC's reward practice, and we jointly often will talk to practitioner audiences about how to redesign pay. And what's surprising is that Tom, as a compensation consultant, his incentive should be to keep pay as complicated as possible, so that you have to hire compensation consultants to say, oh, should we adjust EPS for repurchases? Should we look at EPS or TSR or ROA or ROIC as the metric? But in fact, what I'm proposing is just the simple idea of restricted stock which should make pay much simpler. And indeed, this is what the government green paper's suggestion to extend from 3 to 5 years. This is based on the findings of this paper. Now, I'm not saying this paper was the only thing that the government report was based on, but they certainly cited this paper in the green paper. And I know that Norges Bank, the Norwegian Sovereign Wealth Fund, was aware of this paper as well when they came up with their pay recommendations. And so this is like really gratifying, is that when you write research, yes, okay, for some academics it's to be published in a journal and get academic citations, but for me, my real passion is engagement in the real world, and the fact that this can change some of the debate is really of great encouragement to me. And it's also a great encouragement that we have so many people who've decided to give up an hour to be part of this call and to be so engaged with their questions.
And it looks like we did have one more question pop up into the queue, Alex, and we have a couple more minutes, so I'll go ahead and ask that if that works for you. Did you find any difference on investment decisions between the vesting of shares requiring the achievement of performance conditions and shares that vested purely after the passage of time?
That's a very good question. So just to repeat the question for those who didn't get it, is that there's two types of ways in which equity can vest. One is time-based vesting, which is the example I gave earlier, which says, well, your equity will vest in 5 years' time, regardless of what happens to the company. There's the other type, which is performance-based vesting, where your equity vests based on hitting particular performance thresholds. Maybe you need to have 10% EPS growth compounded over the next 3 years. And we checked robustness to removing those performance targets. So even if we only looked at time-based vesting, then the results held. And why we wanted to remove those performance-based vesting equity is that could lead to causality issues, because the vesting, hitting those targets, could be caused by other things that are driving investment. There is a separate paper also which looks at hitting performance targets. It's called compensation goals, and let me just be a bit more specific. I know pretty much what the title is, but let me give it verbatim. I think it's compensation goals and firm performance. Yeah, in the Journal of Financial Economics. And what that shows is that having these targets causes CEOs to take short-term actions, such as cutting R&D, in order to meet those targets. And this is why I think we should move away from this. So I know that there's some investors and some proxy advisors which have policies to want to put in these performance conditions, and I sort of understand the reason for it. If there's performance conditions, then you're holding the CEO accountable for performance. But in fact, what this research suggests is actually having those performance goals backfires, because you can always take myopic actions in order to meet those performance targets. So this is not to say performance goals are always a bad thing. In certain situations, they could be a good thing. But what I encourage investors and proxy advisors to do is to look at things on a case-by-case basis, rather than perhaps having a general policy that we want to always vote against plans without performance targets, because while performance targets can be good in some settings, they might be bad in others, and this is what this other paper, Compensation Goals and Firm Performance, finds.
And just a couple more questions, Alex. I can see you've got everyone very interested in your research with all these terrific questions. Why do we continue to see large pay gaps between European and US CEOs?
Yeah. So why do we? Okay, so there's a couple of reasons for this. So one reason is that that firms in the US are just much larger. So let's take the average firm size in the US of 20 billion. Well, let's say a CEO, to be conservative, she only creates 1% of that value because there's other employees, maybe the firm was good beforehand. That 1 million, that 1% of 20 billion is 200 million, which is a large amount. So it's not egregious to give the CEO 10 million out of that 200 million. In, say, other countries, so let's say in another country, firm size is only 2 billion rather than 20 billion. Well, again, if the CEO adds only 1% of firm value, that's much smaller. In a 2 billion firm, it's only 20 billion. So put differently, because the stakes are so high in the US, right, the returns for getting the very best CEO are even higher because you can apply that big, good CEO across a larger company. It pays to pay top dollar for top talent. Now, the question was on the pay gap. So you might think, well, why doesn't that argument apply to the average worker? Why can't we say, well, the average worker should be paid much more in the US because firms are much larger in the US? Well, that's because the average worker's efforts are not as scalable. Let's say you are an engineer and you can look after 20 machines a year. Now, you can look after 20 machines regardless of whether you're in a $2 billion firm or a $20 billion firm. So it doesn't matter whether you're working in Europe or the US, you're still affecting 20 machines, and therefore you're still worth the same to the company. Whereas, because what a CEO does is scalable. If she designs a new corporate culture, that can be implemented firm-wide, or a strategy can be implemented firm-wide, and that's why it's why you're being paid more in the US. And notice the higher pay is not just linked to CEOs, it's basically anything that happens to be scalable has high returns. So why is J.K. Rowling paid much more than, say, Tennessee Williams was, when both might be seen to be as good authors? It's just now, like the book industry is much larger. You can now sell your books worldwide and turn them into films. Why was Derek Jeter paid much more than Babe Ruth? One's not more talented than the other. Then it's because the baseball industry is a global industry. So when there are returns to scale in any profession, you see something which is scalable getting high returns for that. And so I had a blog post on that called "Why Has CEO Pay Risen So Much Faster Than Worker Pay?"
And we have just a couple minutes. We can squeeze in one more question. Could you give a sense of how many companies have increased the equity vesting period related to their CEO pay?
I don't know this, unfortunately, because most data disclosures don't really disclose the vesting period. So what we were able to do in our studies, look at when the equity vested, so we could see in a particular year vesting had happened, but we don't know when it was originally granted. And so to the extent to which you investors can push for reform, it would be for companies to be much more transparent on this. So much of the focus has been on the level of pay. There's not so much disclosure in terms of vesting periods, and that's something we'd like to move towards. In the UK, we are going to have this change from 3 to 5 years, and so that will be mandatory for firms. We think that it's probably around 2/3 already comply with 5 years. So when this 3 to 5 year thing gets added, probably then the remaining third will start to comply.
Thank you. And thanks everyone for all those wonderful questions and for your participation and interest today. As a reminder, this research, both the research papers are posted on www.irrcinstitute.org. We will have this slide presentation as well as a replay of this webinar posted shortly on the website. If you have any questions or comments, please reach out to us. You can find our contact information on the website, and Alex is also available. Thank you again for your attention, and congratulations again to Alex, and we thank you for taking time to share this important research with our audience. Have a nice afternoon.
You're very welcome. Thank you.
Thank you. Okay.